working with the ratings agencies and the major index companies, the NASDAQ index and S&P, et cetera. Basically, these are passive index vehicles that are the drivers for literally hundreds of billions, if not trillions, of passive investment dollars by investors, regular investors like you and me, into these funds. And they are forcing these indices to accelerate the onboarding of these IPOs, these companies, in a matter of days, 15 days in the case of SpaceX, whereas normally you would have to have your company be seasoned in the public markets for at least a year before you're considered to be qualified in a passive index. And most of the index companies seem to be amenable to letting SpaceX in earlier, likely OpenAI, if they ask, and maybe Anthropic, which is both a good and a bad thing. It's a bad thing in my view, and I'm the AI analyst. I've been tracking this stuff for 30 years, really for looking out for what's good for investors, what's good for the investors on the public side, on the private side, these dynamics. And I think this is a bad trend where the big IPOs, because there's so much money at stake in terms of fees and prestige, they're literally force feeding these IPOs in shorter durations into the passive funds. And I think this is a big issue because it affects a lot of regular people who don't really pay attention to this stuff. These indices are what's called market cap weighted, which means if you have something that collectively these three companies are going to be $3 trillion, that could be 4 or 5% of a major index, which means your portfolio, whether you like companies that are overvalued, undervalued, profits, no profits, AI bubble, no bubble, you own it, and you're not going to get rid of it until you sell your index. So I am arguing for regular folks to start paying a little attention. This is not investment advice, but just pay attention to potentially shifting some of your passive index dollars from market cap weighted indices to equal weight indices. So in other words, today the 6 major mega companies are 40% of an index. In an equal weighted, it comes down to 10% or less, which obviously means not a good thing. If these companies race ahead of the market, you're less represented, but it adjusts the risk reward, especially at a period where companies like Elon Musk, Elon is literally right now forcing all of his bankers, all of his lawyers to use XAI so it generates hundreds of millions of revenue short term that he can put in the prospectus for XAI as an argument for why regular folks should actively buy SpaceX in the IPO at a valuation up to $2 trillion. $2 trillion. There's a lot of good pieces of SpaceX, Starlink especially. I've written a lot about this stuff as a professional analyst for 30 years. Again, not investment advice. This thing is not worth $2 trillion. Some of the parts analysis that I would do would put a generous valuation at less than $500 billion. This is Tesla is the mother of meme stocks, as I've said. It trades at $1.6 trillion market cap. Most of its business just being the auto business, which is worth less than 250 billion. But it stays there because everyone around the world is bought in to the Elon Musk meme, which is fine. This can continue for a very long time. But this stuff, when gets force-fed into indices, is not a good thing. This force-feeding of mega-IPOs into passive indices is force-feeding geese to make foie gras. Not a pleasant process, not good for the geese. And we are the geese. If you're a passive investor, we are the geese. So I just wanted to highlight this as a major